Okay, thank you everybody. Welcome back. I hope you enjoyed the short break. Moving on to our second session today in OurCrowd University is the art of follow-on rounds and how to really double down on those good companies that I was describing before and how to maximize and optimize your outcome in those companies that we've identified in the portfolio to be breaking away from the herd, those companies that are starting to show sign of success that you want to move through, that you want to be able to double down on. If we start the presentation by just talking about some VC trends that we see in the market today, we find two very apparent truths. Number one is that startup funding is up massively. Last year alone, $130 billion was invested into startups, okay? And that didn't happen by itself. The reason that was able to happen is because funds are growing at the same rate. More and more funds are coming. This data actually excludes some of the outliers. SoftBank's $100 billion fund will be somewhere up there at the moment. So we take out those anomalies and we find that funds are getting bigger and bigger. And as those funds are growing, any one check has to be meaningful, and therefore the check sizes are growing. So you have this self-propelling issue that as the rounds get bigger, the funds get bigger, and that really creates the next iteration of further rounds that are bigger and bigger, etc. And that continues. We see actually that in 2018, startup investing was up 3 times what it was just 5 years ago. Okay, and this doesn't seem to show any signs of slowing down whatsoever. But if you peel back one layer, what you find is that the investment is going into these huge rounds. These huge rounds. Last year alone, of the $130 billion, $21 billion went into deals that were of more than $1 billion per deal. Okay? If you go back, or if you expand that group a little bit, what we find is that an additional $40 billion, in total $60 billion, okay, went into deals of more than $100 million. And if you look at generally what a growth round, how we define a growth round of more than $50 million, most of the capital, 62% of all invested capital, went into single rounds of more than $50 million last year alone. And this trend doesn't seem to be slowing down whatsoever. The whole market is moving into these hugely prolific growth rounds. What this means effectively is that the old paradigm of companies IPOing after 6 to 8 years is really being pushed down the road. Okay, and companies are staying private longer, and it's not uncommon now to see companies waiting 10, 12, even longer than that, years before they go to public markets. If at all, many companies are actually missing the public markets and jumping straight into trade sales or M&A. If you look at a few examples, companies that were founded before 2000, some of the most prolific and prominent high-tech companies, eBay, Amazon, Salesforce, Google. If you look over here at the amount of money these companies had raised in the private market and the valuations, pay attention, these are all M's for million, okay? Go to today, what's happened, some of the more prominent companies, all the M's have become B's. Uber alone has raised $20 billion and is potentially going to IPO this year at a extremely high valuation. But until that happens, really, we have to wait to see. So what's also interesting is comparing over here 3 years, 5 years, 6 years before these companies went public, and in today's context, we see 9, 10, 11, 12 years before some of the more prominent companies are going public. So we see that companies today are staying private twice as long. Okay, and what this creates is a tremendous opportunity for private investors to stay on along the ride for as long as possible and really to take advantage and to optimize that real wealth creation whilst those companies remain in the private life. A slide I showed in the previous presentation, again, comparing the previous companies, once they IPO'd, this is the value creation in the public markets, where as a public shareholder, you could still create very, very high returns in the public market. Today, that is not the case at all. The private companies are creating all of their wealth in the private stages, and there's really a very, very little amount of value created in the public space. If you look at LinkedIn as just one example, LinkedIn IPO IPO'd at a $9 billion valuation. They created $9 billion for its private investors. It sold to Microsoft a few years subsequently at $26 billion. So your public shareholders created 2.5, 3 times their money, nowhere close to the $9 billion that was made by the private shareholders. And to make this point a little bit stronger, if we just look at these 3 companies that IPO'd after 5, 6, and 3 years respectively, had they stayed private for 12 years, like we've seen in today's ecosystem, they would have created an extra $200 billion of value to their private shareholders. Okay, so there's no doubt that these companies today are staying private longer. They're creating much more substantial wealth creation for the private investors, and at that stage they IPO with really trickles of value available for the public market. Looking at the ecosystem last year alone, we had almost 3 times more of these mega rounds of more than $100 million than we had actual IPOs. So a new phrase that I saw the other, these private IPOs, that was coined by Upfront Ventures by Mark Suster over there, where you have that the private market is actually providing the growth capital to companies that we haven't really seen before. So we have this new concept of private IPOs as the private market is really propelling these companies forward. If we look at that in the context generally of where VC is today, where it used to be, we have that today 1 in 2 deals is actually a growth round of more than $100 million. Okay, compared to just 13% of the deals where it used to be 5 years ago. So whilst let's call it traditional VC over here, these venture deals that are being done at less than $100 million, these early stage A, B stage deals, that's grown only 14% over the last 5 years. These mega deals is grown at 60% compounded average growth over the last 5 years. The whole world has moved towards these mega funds, mega deals, and late stage. Doesn't seem to be slowing down at all. In fact, we're expecting this year also to have very, very high numbers over here. If not 200, then certainly actually more than that, excess and more than that. Certainly that's what I'm hearing from the market. It's companies that we see within our portfolio. It's the legal firms that we're working with as well that's communicating this to us, that companies really are staying private longer and taking on these tremendous amount of rounds. So whilst we do see this trend that the time to liquidity is being pushed out, we do also find that the best VCs and therefore the best LPs are very, very well positioned to take advantage of the opportunity to continue to finance these companies through each of these growth rounds. Okay, and in order to do that, the pro rata right or your preemptive right, which I described before, which is that right that allows you to continue to follow your companies through all their additional financing rounds, has become more critical today than ever before, and has become more of an asset today for LPs and for funds than that's ever been seen before. At this stage, I would like to hand over to my colleague ETAI KRAMER, who manages our fund team and our fund products, to really talk about the benefits of preemptive rights. Sorry.
Hello. Thank you, SHMUEL. I'd like to pick up where SHMUEL left.
Sorry.
And talk about. Are we okay there? I'd like to talk about pro rata rights as a valuable asset, and maybe try to tie it into OurCrowd's fund investment strategy. So, for those of you who weren't at SHMUEL's previous, previously when SHMUEL described what pro rata rights are, let's do a quick reminder. Pro rata rights allow you to maintain your equity stakeholdings in the company. So a very, very simple example, maybe oversimplified. Let's say I own 10% of a company, and the company's doing really well. And now it's raising an additional $10 million. So if I have preemptive rights, right, I will have the right to participate and fund an additional $1 million into the company. 1 out of 10, that's 10%. So post money, I will still maintain my 10% equity stakeholdings in the company. Now, sticking with this example of a company that is doing really, really great. If I'm an investor in a company that appears to will be a unicorn, right? It's doing really great. Would I want to have the right to maintain my equity stakeholdings in the company when additional money comes in? Of course, right? I'll do whatever I can to maintain that, because the more exposure I have to the company, then when the company will exit, I will have, right, I will get to enjoy that exit. So I want to be as exposed as possible to that company. However, there's always an however, we do see that in practice, even though investors secure the right to have preemptive rights, they don't necessarily exercise them. Right, and there are many different reasons why, and we'll discuss a few of them real quickly. But the simple example is lack of capital. For example, if I'm an angel investor investing in a company, I went in early on, I have a nice stake of the company, but as valuations increase, size of rounds are greater, then I might just not have the money to put in order to maintain my equity stakeholdings. Right? If we go back to our initial example, I had to fund an additional $1 million. Now that $1 million could be $10 million, it could be $100 million, based on the size of the round. Another example why preemptive rights may remain, and preemptive rights, pro rata rights, participation rights, it's all the same term in terms of this context here, so we'll use it interchangeably. Another good example of why preemptive rights remain unexercised is, let's say I'm a VC fund, early VC stage fund, I'm investing in companies, and typically LPs will demand from the fund managers to have a limitation in their investment mandate not to be overly exposed to one company. So if just to remind how funds work, we aggregate capital commitments, we close the fund, we have these commitments to deploy these commitments when we need to make investments or pay for expenses, and the LPs often will say, you know what, I don't want you to fund any company in an amount that is in excess of 15% of the aggregate capital commitments of that fund. It's a similar case, but also diversity of the portfolio. We want to make sure that the fund has a strong, diverse portfolio, and therefore we're going to say, okay, I'm not going to, even though the company might be doing great, I'm going to say I want to keep follow-ons for other investments. So going back to what SHMUEL described slightly earlier, we know now that companies are growing bigger and faster than ever before. We also know that companies are raising more capital in private markets. And we understand now that there's more value to be captured pre-IPO than post-IPO in many cases, right? Now, all of these things all of these trends, if you will, are leading to, at least when we're talking about the breakout companies, to be very competitive rounds, right? Everybody wants in on a winner. And this is where preemptive rights are becoming very, very valuable. There's a famous quote by John Backus, which is one of the managers of, he's the GP of a fund called Proof, which we invested in. But I won't read the whole thing. But if we stick to our example that I'm an investor in a really good company, or let's say I'm a VC who's interested to participate in this competing round, right? So I can go to the company and try to convince them that I have this added value and they should take my money and not a different VC's money. I could say, you know what, I'll give you better economic terms. I'll fund at a higher valuation. Or I can say, I'm an existing investor with preemptive rights, so you have to take me as part of this round. And this is where, again, where pro rata rights, participation rights are becoming very, very valuable. And this trend in venture firms about 8 years ago started to understand how valuable these preemptive rights they own, right? And then began this trend of what we call continuity funds, pro rata funds, opportunity funds, overage funds. They're all different variations of pretty much the same thing. And what they do is these funds provide access, a guaranteed seat in the table, to these follow-on rounds in breakout companies within their existing portfolio by taking advantage of the preemptive rights, right? And going back to OurCrowd, right? OurCrowd today has over 170 portfolio companies, and we secure our preemptive rights across these 170 portfolio companies. So when we make an investment in the company, and now the company is kind of breaking out, and we see there's strong positive momentum, so we'll go back to our initial LPs and we'll say, you know, we're going to have this follow-on round. Do you want to participate? Some will, some won't, for the same reasons we discussed before, right? And that leaves OurCrowd with unexercised preemptive rights. Now, what's exciting about these continuity funds, they allow new investors to invest in follow-on rounds, even though they weren't initially investors in these companies, right? And how do they do it? They are able to take advantage of these unexercised preemptive rights. And in 2016, OurCrowd launched its first continuity fund. We wanted to implement or have some investment guidelines to make sure that these companies are really, that the fund will invest in really companies showing strong positive momentum. And we did that by deciding that the fund will only invest in up rounds, right? Up rounds, follow-ons that are up rounds, led by either a strong institutional or strategic investor. And that provided the kind of the validation that we wanted, that this fund will only invest in these companies signaling strong positive momentum. Now, to date, the fund made 19 investments in what we believe to be a very strong and diversified portfolio. And it includes cybersecurity companies and agtech companies and healthcare companies, and of course, mobility company Jump, which we all know was recently acquired by Uber. So we're very, very excited about this investment strategy. We're soon to launch our second continuity fund. And I think I would like, at least, that the takeaway today from this short session is to understand that pro rata rights, preemptive rights, could be a very, very valuable asset if utilized correctly within your investment fund strategy. SHMUEL, I'll hand it back to you. Thank you.
Sorry. Thanks, ETAI. Thank you. What ETAI is describing is those circumstances in which we want to take advantage of companies that are continuously doing these up rounds. We do find circumstances, though, where companies, for a myriad of different reasons, unfortunately don't raise at the valuations that they were expecting or hoping to raise money at. Sometimes companies run out of cash. It's hard to raise more money. Many reasons why. And we as a fund look at these opportunities and try to take advantage of the low valuations and invest in good, stable companies, but not necessarily at the higher valuations, but at the lower valuations, and take advantage of that and actually build our ownership stake in these companies despite valuation. So when companies raise money at low valuations, you have what's called a pay-to-play. There's two primary economic provisions that come into pay-to-plays. The first is just that the valuation is simply lower. So in a scenario, let's say you have 4 equal shareholders in a company's worth $10 million, each one will be holding $2.5 million of value. If the company then goes and raises money at the aggregate of $2.5 million, every single one of these shareholders will be taking a haircut of 75% of their carrying value. Okay, so that is the most common, where you just see that the valuation is low and you're writing off or you're impairing your investment. But much more critical to that is in situations in which the new round is done and forces all the previous preferred stock to be converted to common. If you're here in the previous session, you remember all the significant rights that are bestowed to preferred shareholders. The most significant in this case being the liquidation preferences. Okay, once you lose your preferred rights and you go to common shares, at that stage, when the company does liquidate, you'll be reliant only on the situation in which the company liquidates with enough assets such that even the common shareholders are able to extract capital, not only the preferred shareholders. Again, that was something we addressed in much more detail in the previous session. You could lose your preemptive rights, so if the company does turn around, you won't be able to take advantage in the situations that ETAI was describing. You could lose your board seats and information rights and really have fly blindly going forward in the company. So when companies do pay-to-plays, it's also something very important that we look at and we keep an eye on. At this stage, I'm going to have a short fireside chat. I'm very happy to invite to the podium or to the stage over here Ron Stern, who is a general partner at OurCrowd and manages our portfolio, to DROR SHARON, who's the founder and CEO of Consumer Physics, which was OurCrowd's very first investment back in November 2012, and AVRA Van der Zee, who was previously GC and head of strategy at Jump Bicycles, which was bought by Uber. So guys, please join me. Thank you. Okay, DROR, if we could start with you. You led your company, Consumer Physics, through an incredibly aggressive pivot, taking it from a consumer product hardware sale to a B2B SaaS enterprise company. So I guess the question to you is that at what stage do you realize in your business that the only way for sustainability was really to take the company through this new channel?
Can you hear me? Yeah, it's okay? Okay. So I think our aha moment came when we had a partnership, actually a very successful at least launch of going into the consumer business, through Kickstarter was one of the probably top 15 at the time, and then we capitalized on it to take it to the next level and bring it to the phones. At some point we realized that unfortunately going into the phones, while it's going to happen, it's going to take longer and it's going to be more expensive for us. And at the time we were recruiting we were really ramping up toward a very aggressive timeline that all of us rallied around. And once we realized that we're not going to hit those timelines, the revenue is not going to appear when your burn rate is going this way and your expected revenue was supposed to be this, but you need to, just basically need to recalibrate. It was clear that we need to reevaluate, look at the assets that we have in the company, and luckily for us at the time, because we're an open platform with then it was thousands of developers, now we have many more. Some of them, the engagements turned into real potential SaaS businesses. We looked at the asset, decided this is where we need to focus on for, take the company forward, and did the hard thing, which is to, declare that this is what we do and go for it.
So on that point, if I could just extend, we had conversations about this at the time when you were looking to do this pivot and the recap in the company. OurCrowd, amongst all your other investors, of course, we're going to have to impair all of our investment in the company. You were going to impair your own investment, and of course your employees as well. That conversation to have with all the different stakeholders, of course, is without a doubt, you told me, was the hardest part of your function to date as a founder, CEO of a company. So in Mark Andreessen's words, what was the hardest part of that hardest part?
So, first of all, the hardest part was the team. Investors, to be honest, they take bets. You all take bets. I took a bet in the company, so we take bets. The team, actually, folks that you recruited, the livelihood, so you need to rationalize the team, you need to repivot. This is by far the hardest conversation, going forward and making sure that we rally against the cause. And then we have a myriad of investors who are OurCrowd and others. That is obviously a difficult conversation. We were very lucky, actually. Over 70% of our investor base re-upped in the recap. So we are very, very fortunate, I think, to have very supportive investors that saw the potential in the company. And I think, in a few years, all of us, kind of all the investors, will be vindicated in doing that. But very, very fortunate. The ones that actually didn't invest in the recap came to us and said they have, a singular position that they just couldn't, at the timing didn't work for them. But we had to do it and make sure that we, again, the revenues were supposed to go to tens of millions immediately with these partnerships. They didn't materialize. We need to reevaluate and do it.
Right, Ron. This is a graph that you've lived by since you joined OurCrowd a few years ago. We had a very material stake in consumer physics before the recap. We are now actually looking to increase our position in the company. So how does that fit into your thesis, and where do you see consumer physics today on this graph?
So sure. Hello.
You need to.
No. Okay, I'll just try to speak loud. Maybe someone can. Is it working? It's working. Okay, thank you. So this is a graph that very clearly views how we look at an investment. Basically, an investment starts with creating a little bit of value over a long period of time, and then there's a certain point in time that we see an inflection point, and that's what we're looking for in our companies. In the case of consumer physics, is there an echo here, or am I just hearing?
Yes.
So, in the case of consumer physics,
maybe it's me.
yeah, I have an idea. Maybe I'll just do this. Is this better?
Yeah.
Okay. No. Sorry about that.
Yeah. Yeah. Hold it.
Yeah. Is this better?
Yes.
Got it. So in the case of consumer physics, basically there was a drop, obviously, before the inflection point, and that's where we need to do a recap that DROR discussed. But what we see now is we see real traction in the company, real consumer traction, SaaS model, customers that are paying 10 times a year what a consumer customer would have paid, in some cases more, and that gives us a lot of confidence. We always look ourselves in the eye of the company and the founder, and say, did you reach this point where there's a clear inflection point, there's clear validated third-party traction, and in that point we like to double down and take an opportunity, and we've done that several times in the last year.
Right. AVRA, turning, Mike. Okay. I'll come up.
Oh, there you go. You're good.
Turning back to you now, Jump, of course, had a tremendous amount of hardware, and it was a capital-intensive company. At the same time, you also had very long sales cycles, getting into municipalities, into cities. There was a stage where the company, was in a cash crisis. So, what went wrong? How did the company mismanage its cash resources?
Sure. So, I mean, can you guys, can you hear me? Hello? Hello? Hello?
Up you good.
Hello? Okay. Hi. So I'm AVRA from Jump. So at the time we were raising money, we didn't fit any neat VC bucket, right? We were a hardware company with a complicated supply chain. We engaged with cities and so had a long sales or engagement cycle via permits and RFPs. And in addition, we had this transformative e-bike product that was really game-changing, but we had yet to publicly deploy it in a public pilot. So in terms of fitting a particular mold for an investment, we had early-stage investors already. We had OurCrowd on board. We had some great early investors. But we were raising a next round before we had this sort of transformative moment where consumers could really experience our product. And so for us, it really was seeing was believing. People needed to experience our product and understand the joy of the commute that would happen when on one of our e-bikes. And it was at that moment that we had the transformative, it was a game changer. And that's when we were able to really attract the capital. And for us, it was important to have really strong early investors to help us get to that point.
Right. I guess before that point happened, no, you could sit. It's going to be for on. Before that point happened, the company, ran out of cash. OurCrowd landed up writing a check, which I think we would say saved the company during that short term. Ron, over the years, you've told so many companies that unless they have meaningful traction, they shouldn't be coming to OurCrowd. What was it specifically about Jump at that stage that you saw? And at the time, you were very new to OurCrowd. So my question to you, if I could be blunt, was that a financial investment? Or was that a cowboy move as you started your new position here as head of portfolio?
So I don't think it was a cowboy move, but what we had with Jump, the team at Jump and was very passionate and very clear about the bike, and that this is the best bike in the world, and at the time, and truly phenomenal. And you hear a lot of times founders say that about their products. I think in this case, two things happen. One is I actually got to ride the bike, which, as AVRA says, was a game, a phenomenal experience. But that was emotional. That's not necessarily rational enough for me. But what the other thing that was happening is that because we had an observer on the board and we were very close to the company, we knew that the company was about to sign a distribution agreement with Uber to distribute their bike, to add the bike to the Uber app. And that was a game-changing and external event that you could validate. And we were getting prepared. We went through our investment committee. We talked to our investors. We were getting prepared for the day that Uber signed the term sheet with Jump. And in fact, within 11 days of signing that term sheet, I went and checked how quickly it was. We were able to transfer a convertible loan that allowed the company to purchased the bikes for their initial pilot, and
Right.
after that was the inflection point. In
And then subsequent to the CLA, a very prominent venture capital firm from the Valley came, and they gave tremendous credibility to that decision. They led a much larger equity round, and we actually increased our position in the company, which is also quite rare for a fund. We went from about 7.5% to 12.5% post that round. How important was that move for OurCrowd, and in terms of setting precedents in increasing our position in follow-on rounds?
I think, you know, what we're trying to do as a portfolio team is identify which of our companies have breakout moments like we saw before, or like we discussed here with Jump, and which ones are going to be big winners. And obviously, when you have a situation where you strongly believe that a company is going to be a big winner for you, you want to own as much of the company as possible. So we initially invested $1 million for 7.5% stake of the company, but then when the leading VC came in, we were able to triple our investment in the company and therefore grow, as you say, from 7.5% to 12.5%, which is material.
Right. And DROR, changing gears back to you, a pivot and a recap. Any way you look at it, any way you're going to slice that, shows some sort of failure from the company's perspective. Can you put your finger on that point or that issue that you identified to be the reason or the cause for the failure and what you learned in it? And the second part of the question is, did you ever think of throwing in the towel and just walking away?
So I want to answer the second question. That this is what you sign up for. So I think you sign up for going and taking it all the way. But in terms of putting the finger on it, I think that once we realize that the cost point is not going to go down to a commensurate level where we can actually go and make 10 million of these sensors at less than $10, which is what we need to hit in order to get one of those major phone makers to go for it. Then, with this clear realization, let's see, what we need to do. I think that in a way, what you see now in the smartphone market just shows the trend. People try to differentiate on every axis. Barcelona that just ended, they have foldable phones for $2,600. They have 4 cameras, so our sensor should have been as affordable as one of those cameras. So if you have 4 sensors there, one of them could be a spectrometer that can provide additional value and provide repeat usage. For sure that 4th camera will see less usage than a side device, embedded inside a smartphone. That's at least my belief, and that's what our data shows from our consumers. We have long-term retention that is much higher than some of the other Bluetooth accessories around. So, I still very much believe in that vision, but you need to face the reality. And if the reality is that you are going very fast toward that goal, but that is not going to materialize in the short term, better hold the brakes, navigate the ship toward a different place, and that's what we did. The only answer I can give you when people ask me, since I've done a recap and a pivot as a VC. I invested in a company and went in a management team that did this, and I now did it as a founder and a CEO. So the only thing I tell people, whether it's founder, CEO, investors, are talking about throwing in the towel is there's a Ben Horowitz book, The Hard Thing About the Hard Things. He has a blog post that is called The Struggle. You just go read that, understand that you are going to have very difficult periods, and you just need to plow through that adversity.
Yeah, a very worthwhile read.
That is what you need to do.
Right.
That's what we're doing now. And we are basically at the cusp, as you know, since this is what Ron was just saying, we're, I would say, at the final touches of that pivot, and the customers that are now re-upping a 3rd time, expanding with us. These are super lucrative unit economics, as Ron said. Since you guys looked at the contracts and you did the investment, we feel very powerful about where the company is going. Just with this trajectory, without the upside of one day going to consumers and all the other large businesses that can make it billions of dollars.
Right. Ron, 2 very different companies over here. One being financed for growth, another one being financed in a recap. When you think about reservation of capital for follow-on rounds, I've seen between 40% to 60%. How do you see that world of reservation?
I think between 40 and 60 is right. Depends where you invest. I know some early stage investors, seed and A stage investors hold as much as 2/3. of the investment for follow-on round. But I think this is a very, very important lesson in both of these cases of Jump and consumer physics on how actually the majority of the holding in the company is going to be a follow-on investment in both these cases. And if we hadn't reserved or hadn't understood that, we would have missed out, at least at the Jump case that's already a done exit. We would have missed a great part of our opportunity, and I feel the same will be for consumer physics. And I'm not sure all of our investors understand that. So I want to take another second to discuss this. Is that people need to understand when you're making an investment in a venture company, these companies tend to come back to raise money every 12 to 18 months. That's a completely normal thing in venture investing. In many cases, that's a very good thing that happens for the company because it's growing and needs more capital to achieve its new, more ambitious milestones. And so when people make investment in venture capital companies, they should always think about leaving some aside and expecting that the company will come back in 12 to 18 months. And you have an opportunity to invest more. And in fact, if you see good things happening, at least in my view, that's when you want to double down on your best companies.
Great. Okay, thank you. That's going to conclude the Fireside Chat for today. So thank you to DROR and AVRA and Ron, and I appreciate everybody joining us today in the session. And please enjoy the rest of the great content that's waiting for you outside.
Thank you.